You think I'm going to let you go so easily? So, a small bonus for you for people who have stuck till the end. How reading financial statements can detect frauds in your business. Just a 2-minute line, I will tell you just 3 things which can help you understand if there's a possibility of a fraud in your business. This has happened in all the biggest fraud you have heard of. The Enron fraud, the Satyam fraud in India. There are so many frauds which have happened, and you will find a common recurring theme in them. Let's see what are those themes. There are basically 3 main things which we usually find. Number 1, the cumulative cash flow from operations falls short of cumulative profit after tax in past. So how can you check if your employees are committing frauds or you're not being shown the true picture in your operations? Take last 5 to 7 years profit after tax, that is net income, and takes last 5 years cash flow from operations in your cash flow statement. Add them up. And if there's a huge difference between what? Between cash flow from operations, cumulative cash flow from operations of last 5 to 7 years and cumulative net profit, then it may be because the management or your professional or your employees are inflating the company's revenues. How? By either showing revenues recognition which shouldn't be recognized or recording false or bogus revenue. This was what was happening in the case of Enron also. The second one is increasing receivable days and days of sales outstanding. So when you are inflated revenue, but you are not getting any cash into the business, what will happen? Your receivables will increase a lot because you will not have any backing of cash collections from those bogus receivables. So this will lead to increasing amount of account receivables or trade receivables or debtors in the balance sheet. How to check if those debtors increase are not in continuation with your sales? Well, the increase in debtors will be at a faster pace than the increase in sales. And you can check that by using a very simple ratio. Take the number of accounts receivables, that is debtors, divide by the number of sales into 365. When you do that, you will find receivables days. And if the receivable days, check it for the last 5 to 7 years. If they are increasing at a very high amount as compared to increase in sales, that means that maybe you are being shown receivables which are not actual receivables. And the third one and the last one, there's a very fast build-up of inventory. Or the other part, if there's a fast build-up, it will be shown by decreasing inventory turnover. So what will happen when you want to see a lot of inventory? Inventory build-up basically indicates that the company might be carrying huge amount of old inventory in its balance sheet, which might not be useful anymore. And what employees and managers do, they don't want to recognize this inventory as losses because writing off this inventory will affect their performance when it comes to reviewing their performance or their employees' performance. So they will not like to book the impairment losses and reduce the profitable earnings. And they will keep on showing this inventory in the books, which in reality has become old and worthless. So make sure if the inventory is increasing a lot as in the last 5 to 7 years to check if your financial statements or your companies have fraud in it. So this is a bonus segment which I made for the people who stuck in the last. Finally, I really want to thank you from my heart that you put your mind and time for this course. I hope I was able to add value. If you like the course, obviously the like and subscribe button is there, and please check the link which I put in the description. It shows much better courses and much bigger courses which I have made for you guys. Thank you.